ticket and she ran up to the car and pretended that it was hers. But
Well,
it wasn't.
that was very nice of her.
Thing.
Okay, so guys, let's continue talking about the revenue recognition. So recognizing revenue prior to completing all of the earnings process is going to happen when we're dealing with large contracts. And when we're dealing with percentage of completion method, that's dealing with what type of contract? Are we talking about services or are we talking about long-term construction? Long-term construction. Boy, you guys must have read the chapter. And then when we talk about proportional performance method, what type of contracts are we dealing with? Primarily service contracts. This is a way in which we show the earnings for portions, for sub-portions of the full project. Does that make sense why we do that? Do you get tired of me asking, does that make sense? Recognize revenue at the point the earnings process is completed. Well, to recognize revenue at the point the earnings process is completed, that's what we're familiar with. What's the difference between accrual basis and cash basis? Under cash basis, when do we recognize revenue? When we get the money. But the biggest thing you guys learned in Financial Accounting 222 or 221, the accrual method, you recognize revenue not when you get the money, but when you complete the job. When you've actually earned the money is when we accrue the revenue. The deferral method is used when customers pay for the goods and services in advance. So when I was talking about that retainer that a lot of attorneys use, or in my case, I'll use it for audits, I will receive money up front. That money technically gets debited in my books as cash. The credit is customer advances, right? It's a liability. I haven't earned the work yet, have I? I debited cash, but it's a liability. Then as I complete a portion of it, I get rid of that customer advance, or I debit it, and what am I going to credit? Revenues. Services earned. Make sense? So the deferral method is you receive the money up front, but it's a liability until you earn it. And then you show those portions of earnings as you complete certain parts of the job. Completed contract method is used for long-term contracts. It recognizes the revenue when the earnings process is totally done. Recognizing revenue after the earnings process is complete, what happens in the installment method, you sell your business. My client who sold their business, the earnings process is complete, but she's treating it as the installment sale because they didn't pay her in full then. They're paying her over a period of 4 or 5 years. You show the income as you're receiving the money because you're kind of concerned that you might not get the money. So you don't want to show that you don't receive the money, or you don't want to claim all the income until the money actually is in your hand and you feel confident you've recognized that that ability to receive that money is realizable. Make sense? Okay. Cost recovery method delays recognition of gross profit until the entire cost of the product is totally recovered. So basically, let's say that there is a big construction project. The construction project really costs the construction company $20 million. Now, the sales are, the bid is for 24. But do you want to even claim any bit of revenue until you get all your money back just in the product cost? Make sense? So the cost recovery system is used to defer profit until everything else is recovered. It's probably the safest way of doing it, isn't it? I want you to know, be it matching, I want you to know about these terms. So if I give you matching about cost recovery or installment or completed contract or an example, you're going to get to match the type of contract with what type of contract it is. Since you told me you love matching, I'm going to give you some matching, okay? And you see how I make them perfect? Like I don't have 5 matching with 20 items. Did you see how wonderful that is?
At first I thought that because I didn't scroll down and I was like, no.
Heck no. Okay, so know these terms. Even though we might not have a problem on all these terms, I still think you need to know. If I ask you a question, which method is this? You would know. Make sense? Long-term contracts. Percentage of completion method recognizes revenues and expenses and profit each period into proportion of the amount of the contract completed during the period. Let me tell you the tricky part about this though. You initially start out, let's just think of 35W. They initially estimate as best as they can all that needs to occur. And they try to calculate at this point 5% of the work is done, at this point 10%. But guys, it doesn't always work that way. What about rain? What about snow? What about this winter? Do you think things don't get completed as scheduled always? I think it happens more than things going perfectly. Things happen beyond our control. Sometimes things take longer than others. Sometimes there's hiccups in the way. People can't work as expected. Products don't get there in time. So this has always got to be modified. So in a perfect world, you know, and we do this based on what we know at the time. But then sometimes we'll have to go back and revise our numbers based on new information coming in. That's where this method is challenging as a problem or in real life. It's just the truth, but sometimes we have to revise these figures. Also increases the value of inventory minus any partial billings. The completed contract method, we don't recognize profit during the life of the contract, only after the whole thing is done. GAAP requires that construction companies use percent of completion method when we can reasonably depend on the estimates. The contract clearly specifies enforceable rights regarding goods and services to be provided and received by the company and the buyer. And the buyer can be expected to satisfy its obligations under the contract. The company expects to perform its contractual obligations. We are required to use percent of completion method if these 4 items are expected to happen. Do you see that? Completion method, when all these items are met, we need to use the percent of completion method. Why do they have these guidelines? Because that will help specify that the earnings process is complete and that we are fairly certain we're going to receive the money. Okay? How do we account for the percentage of completion method? We'll have to somehow determine the percent that was completed. And there's 2 methods of doing it. Cost to cost method, where you compare cost incurred to date with the expected total cost for the contract. So if we know we're going to have $1 billion in cost, after the first $2 million, we're going to show a certain amount completed based on costs. Or efforts expended, work measured by work performed to date. So there's going to be a tangible way in which we try to determine the numbers based on something tangible we know of. Again, bids are always put in there to show variances, because in a perfect world, you try to do the best you can based on what costs are going to be, but a lot of times they're going to tell you it's cost plus a certain percent, just in case prices go up or down. So efforts expended is based on work performed, labor hours, dollars, machine hours, machine quantity, material quantities. Output measures use results achieved to date compared to the total expected results to measure this percentage of completion. Here's an example. Cameron Company contracted to construct a stadium that takes 3 years to complete. Cameron estimates the percentage completed using the cost-to-cost method. So here we have all this information. In 2013, we're expecting various costs. 2014, we've got expected cost in 2015. So we've got the total contract price of $700,000, and we have construction costs that were incurred in each year, and then we have estimated costs to complete the project. And then you see things are going to revise. Do you see in 2013 how we estimated costs of $400,000 to complete the project? But it went over $400,000, didn't it? It's $500,000. Do you see here we showed after 2013 we're estimating still $400,000 is going to be needed to complete the project. But look what happens in 2014. You see how it's $186,000 and $314? Do you see how things alter? In 2014, they estimated another $264,000. Look what they really spent, $314. So based on what they got done and what they expect left in costs, they at a contract price of $700,000. They'll determine how much they bill to the customer based on the percent that was done. So in this scenario, they incurred costs of $100,000. There was $400,000 left. Excuse me. Whoops. Let me go back here. There was. Where am I? There was $400,000 left, so they're going to show the billings based on the percent of cost that have been completed. Here are the journal entries we're going to talk about. So, initially, under the percentage of completion method, recording construction costs, we've got construction in progress for both, and accounts payable, we're showing both. Then we're going to show a partial billing. We're going to show accounts receivable with a partial billing or sales. Then to record the collections, we're going to show our cash, credit our receivables. Then what we're going to do here, excuse me, we're just doing a partial billing here. But now under the percent of completion method, we're going to determine what our construction expense is, what's in process, and based on that, we're going to show our revenue each period of time. But under the completed method, we're not going to show revenue until it's all been completed. Okay, so that entry gets skipped under this completed contract method. As we move on here, in the income statement, when we're dealing with the percent of completion method, do you see how we show our revenues of 140? We show our expenses of 100 to have our profit of 40 here. Then in 2014, we're going to show our revenue less our expenses. And then in 2015, our revenues less our expenses. We're trying to match. You know that matching principle? We're trying to match our revenues accordingly with our expenses to keep that gross profit margin the same. So here you can see what the accounts receivable is at the end of each period. And then even in inventories, what construction is in process versus what we've already billed out. Again, none of this is going to mean anything until we start doing some problems, okay? Under this completed contract method, are we going to show revenues in any period but only when they're done, right? So even the construction expenses are going to all stay in our construction in progress or in inventory until we match our revenues with our expenses. Remember the matching principle. If we're not going to show the revenues till year 3, we're not going to show any of the expenses until year 3 also. Make sense? Because we try to match them. Any questions? Are you getting it? Okay, so let's take a break here and let's look at what problem were we going to have here? Exercise 17.4, was it? Was it 4, guys? Okay, let me pull it up on the screen so we can read together. Okay, and this is page 17-44. Okay, let's look at this percentage of completion method on exercise 17.4. Here we've got Kuhlman Construction Company began work on a contract in 2013. The contract price is $3 million, and the company uses the percentage of completion method. Other information relating to the contract is shown here. The cost for 2013, the cost for 2014. So we've got our cost during the year and then our estimated cost to complete it. The billings during the year and the collections during the year. Compute the gross profit or loss recognized in 2013 and in 2014. Okay, so you guys have your little sheet there. I'm going to pull up an Excel so I can work this together with you all. And we know here the contract price is how much? $3 million. So here we're going to have 2013 and 2014. The construction cost incurred to date here it is 600,000. Whoops. And over here, in 2014, it's 1,300,000, right? Then our estimated costs to complete in 2013, 1,400,000. And in 2014, 1,200,000. We've got total estimated costs. Here it's 2 million. Here it's 2,500,000. Who's with me so far?
For 2014, I think it's 700,000 it says on there.
So, why do we add together?
Oh,
1,300,000 construction costs incurred to date,
Because it's to date.
and 1,200,000, 2,500,000. I'm sorry, what?
People are just confused how you got 1,300,000.
Okay, so
Because you're adding them together.
look at the costs incurred in each year. In 2013, we incurred $600,000 costs, dollars. And then it tells us that we estimate 1,400,000 more in costs, which basically give us the 2 million estimated costs here. For 2014, construction cost incurred to date. This 1,300,000 is going to be what we incurred in 2013 plus what we incurred in 2014. We've got to keep a running total because things are going to change. Okay? Yes.
But then wouldn't the next one down for 2014, wouldn't that be 2.6 million?
No.
Oh, it's not today.
Okay, think about, these are the estimated costs to complete. Right now in 2013, because it's going to take us a couple years, we're anticipating our cost to be 1,400,000. We're constantly revising. Do you hear the word estimated? Estimated. We never always know. Yes, dear?
So the construction costs incurred to date, though, those aren't estimated. Or
That's actual.
That's actual. So why are we adding the actual with the estimated and then telling it?
We're not. Right? Okay, hang in there with me.
Sorry.
Okay, that's okay.
Done.
That's okay. Why, if we're doing this based on the cost method, we're going to show the percent of completion based on actual cost plus what we still think we have left. Okay? So if we take this and we show that we have completed 600,000, but we estimate our total cost to be 2 million, what is our percent completed here? We're going to take and show our 600,000 divided by our total cost of 2 million. Whoops. This should be a percent here. So if we take this and show that since we've completed 600,000 and we anticipate all the costs to be 2 million, we're trying to determine what percent we've completed. We're estimating it's going to be 30%. But now when we go over here and we say, okay, in 2014 we have a little better view of where things are at, okay? But now we're thinking, wow, you know, we've completed, our costs are 1,300,000 now, but we're only expecting our total estimated cost to be 2,500,000. So we've now completed 52% of the whole deal. See how we're keeping it revised each year, okay? So as we look at this, the first year we thought we completed 30%. In the next year we've completed 52%. So how much revenue have we collected to date? Revenue to date, should that be 30% of 3 million? So revenue to date should be 30% of $3 million, or 900,000. We're basing it on our cost. So if we think we've completed 30% of our cost, we're going to then claim 30% of our revenues. Make sense?
Even though we didn't collect that much.
We're anticipating collection is realizable, but we are reporting the revenue as we've earned it. Not necessarily because we've collected it. We're going to bill for it. But we're going to show this based on the amount of costs we've incurred. We're coming up with the percent, and we're going to use that same percent for our revenues. Since the big project is 3 million and we know we've incurred what we believe is 30% of our cost, we're going to now recognize revenue of $9 million, 30% of our revenue. Make sense, guys? How are we doing? We're doing good? Okay. Now, here, what's going to happen, guys? We've got here 52%. So as of right now, if we anticipate that we're now at 52%, shouldn't we, by 2014, be recognizing $1,560,000 to date of all of our revenues? So this year, revenue recognized in current period. If we've recognized $900,000 in revenue this period, when we get to this period, aren't we going to recognize the difference between what we should be recognizing versus what we recognized in the prior period? Cost incurred in the current year, cost incurred in the current period. We know here we incurred $600,000 in costs, don't we? So here we've got a profit of the 900 minus the 600, or 300,000. Now here, how many dollars worth of cost did we incur? If this is $1,300,000 to date, then we know the cost incurred here, whoops, sorry. So if we show our revenue recognized minus our cost in this period, we would in the 1 year show a $300,000 profit, but look what's happened since the second year. We've revised our estimates and our actual. Now we're showing a loss. Guys, it's the best method. We know how to do it, but we're continually revising it based on the information we know. Okay? Compare the gross profit or loss recognized in 2013 and 2014. Prepare the appropriate sections of the income statement and ending balance for each year. How are we going to do the income statement here, guys? What are we going to do here? Construction revenue is what? Here, 900,000, right? And here, 660. And our construction expense, 600. And this one, 700. Whoops. Any questions? Can I move down? Since you're just writing numbers, do you like that? You're just writing numbers? Next, let's look at our balance sheet. Balance sheet, December 31st, 2013. Current assets. What's our accounts receivable? We showed revenues of 600,000, but what do we have in accounts receivable for the year? Well, what did we collect? We collected 400, so our accounts receivable would be 100,000. And then we would have in here inventory, construction in progress is how much? $900,000, and less partial billings of 500,000 show cost and recognized profit not yet billed. Cost and recognized profit not yet billed, because what is our recognized profit? Our 900,000. So our cost and our recognized profit not yet billed is 400,000. Now, if I take the same information and I do it again for 2014, should I wait? How you doing? If we go down here, our accounts receivable for 2014, billings during the year 850, collections 800. So that is, we have the 100,000 we're carrying over from the previous year, or what we can do is combine them. The 1350 minus the 1200 that's been collected gives us an accounts receivable out there of 150. Construction in process, 1,560,000. How much have we billed? 1,350,000. Right? So the cost that has been recognized profit but not yet billed, recognized profit that has not yet been billed is 210,000 sitting on our balance sheet. Okay?
Quick question. How come we're using the revenue numbers for construction and process instead of the expense?
What we're doing here is we're trying to match, let me think here, construction and process, yet less partial billings, because we're, let me think how to say this. Because we're using the percent of completion method, normally with construction and process, we have our sales and then we have minus cost of goods sold to come up with our gross margin, okay? But it all happens in one period and we keep track of it. Under this method, because what we recognize on our income statement is based on our costs, what we need to do is flow back to the balance sheet, the difference. It's an asset because even though we've recognized it on our income statement, since we haven't billed it yet, it's kind of like an accounts receivable. But it's technically not an accounts receivable because we haven't billed it yet. So it's an asset that we're due. You know, it's in the inventory account. Because this is based on a period of several years and we're doing it based on percentages complete, we have to use our revenues because our expenses are going over a long period of time. And it's not as easy and simple and clean as just showing our revenues and showing our costs or our expenses. So the method to report it onto our balance sheet, we've got to show that portion we've recognized as revenue, but we haven't billed it out yet. Because it's an asset that's coming to us. It's an asset we actually have on our books. You know how we show on our books things like supplies at a cost value? In ways, this inventory is what we're recognizing is what the worth, not the worth, what the cost is of this project. But since it's not being billed yet, and because we're not using the method of showing actual cost and total revenues, this is our formula in a nutshell of a complicated construction process to show what our inventory value is. I'm not explaining it as well as I'd like to, but we've got to show what we actually have in value in an asset. It's not a revenue yet because we haven't billed it, okay? But when we get to a place where we can bill it, then it's going to be reduced by our accounts, it's going to transfer from here over to an accounts receivable. Where am I at here? Balance sheet, balance sheet. Any questions on this problem, guys? What I think let's do is let's take a quick break. I know for me, I could use a quick break. Okay, guys, let's do another problem. Let's look at exercise 17.5. Can we look at exercise 17.5 in the book, and we'll look to do this one.
You want me to write?
I'll type it. Thank you. It's not in there, but we're going to add it, okay? Just to do a problem just like this. Okay, so let's go back to 17.5 here. Newburgh Construction Corporation contracted to construct a building for $400,000. Construction began in 2013 and was completed in 2014. Data related to the contract is follows. So the contract to construct the building was for $400,000. The costs incurred for 2013 is $200,000. The estimated cost to complete is $100,000. Newburgh uses a percentage of completion method as the basis for income recognition. For the years ended December 31st, 2013 and 2014, how much gross profit would Newburgh report? Okay, so let's look at that, guys. If the cost incurred for 2013 was $200,000 and they're estimating $100,000 to complete it, $200,000 in cost divided by $300,000 is roughly a 66.6% completion. If the contract is for $400,000, 66.6% of that money is how much? Roughly $300,000? No, excuse me. Here, let me type it out here, okay? So let's add a new sheet here. So we're going to show 2013, 2014, we've got here costs incurred to date. Here it's $200,000. Estimated costs to complete. This is 100. Nothing. Percent complete. Percent complete. Estimated profit on contract. Gross profit to be recognized. So here we've got so we show here percent complete is going to be the 200,000, divide that by 300,000, right? Or 67%. Or maybe let me just make that 66.67%. So if the estimated profit on the contract, if in this year we know it's 400,000 is the cost of the full contract, what we'll do is we'll show the 400,000 times this 66.67%. I don't know what I'm doing wrong. Sum of 400,000 times the 66.67% minus the cost we've already completed. Damn it. Sorry. Gross profit to be recognized in this period is going to be the $66,666. Right? We're estimating the whole profit as of this date to be 100,000, just based on our numbers. But now things are going to change, aren't they? If the percent that we completed in this period was 66.67, in total we want it to be 100,000. What does the question ask us? Does it say how much did we do in each period? Respectively, how much gross profit should Newberg report? For the years ended both, the gross profit total. So here we know it needs to be 100% gross profit. And what are the estimated profit? Now we've got the cost incurred to date, the 310 divided by our 400,000, right? So our 310 divided by our 400,000 gives us the costs of 78% is our costs. So technically our true profit should be how much? Our real estimated profit now is going to be our 310 divided by 400,000, or really, the difference. 310 minus 400. 400,000 minus 310,000 is 90,000 left, right? So how much profit are we going to, gross profit to be recognized? Now, if we recognize 66,000 in the first period, won't we take this minus this to come up with what we're going to recognize in the next period? Yes? No? Okay. The next, let's go back here. I'm just trying to think, what was the next problem we were going to work on? What was it? Guys, one thing I want to point out, there was a question asked about why do we add part of the profit in inventory. If you look on page 1711, under where it says accounting procedures for the percentage of completion method, It tells you in accounting for long-term contracts under the percent of completion method, a company uses an inventory count called construction in process to record all costs incurred in the project. In addition, it adds the gross profit that it recognizes on the project to the account, so at the end of the period, inventory is valued at not just cost, but cost plus the gross profit recognized. Most long-term projects are financed by receipts from partial billings paid by the buyer. Billings usually lag the amount of revenue recognized, and when these partial billings are made, the company debits a receivable account and credits a partial billings account. The company reports the balance in the partial billings account on its balance sheet as a contra account to the construction in progress. This results in the net balance sheet amount being an asset if construction in progress exceeds partial billings, or it would be a liability if partial billings exceeds construction in progress. So it's a unique way we're recording our construction in process or progress that's unusual because they're such long-term contracts. And it's a combination of our billings are not necessarily tied into always with our revenues that we're recognizing. So therefore that portion of gross profit gets put into that construction in progress. Okay? Take time to look at that. What was the next problem, guys, we were looking at? 17.9? Let me just see which one that was real quick. Okay, let's go back to the PowerPoint, okay? And take a look at the installment method. Don't worry about the completed contract method apart from knowing when do you recognize revenue. When do you recognize revenue on a completed contract method? When it's done. For dealing with the installment method is such when you basically are financing the contract because they're going to pay you over an incremental time, which is very common with a lot of businesses, don't they? They pay you over a period of time. So basically they start with some form of down payment, but they're going to continue to make payments throughout a period. This is also like a contract for deed when people purchase houses and the seller finances the home. It's done this same method. So basically when this occurs, the seller still holds a lot of power with this home or this business because they still own it at some level until it's totally paid off. Make sense? Under the installment method for sales transactions, when collectability of the receivable from the sale, you use the installment method when you're not 100% sure you're going to get the money because you're kind of getting it over a period of time. Here's an example of this installment agreement. Panther Company in 2013 had credit sales of $500,000, total cost of goods $390. They had installment sales of $100,000 in 2013 and $150,000 in 2014. And then the installment method cost of goods sold at $75,000 and $105,000. They divide that difference to figure out what the gross profit rate is on the installment sale. So when they receive money in, 25% of the money they receive in is going to be income or a profit for 2013. And in 2014, 30% of that money they get in is going to be a profit. So it shows you here cash receipts on installment sales in 2013, $20,000 they received, which again, the profit rate's going to be 25% on that. And then in 2014, they received money from that 2013 sale, which on 30,000 they're going to recognize the profit of 25%. Even though that money came in 2014, it's for the installment sale that occurred in 2013. Then for 2014, they received $40,000 in money on the installment sale that happened in 2014. So on this $40,000, 30% of that's going to be profit. Make sense? How many of you are following me right now? Do you want me to say it again? So this company has normal sales and they have installment sales. They had a huge installment sale in 2013 where they were going to receive $100,000, or that's the sales price, on $75,000 of goods. But they didn't get that whole $100,000 in 2013. They got 20 of it in 2013, and they got 30 of it in 2014. But how much is still missing? 50. They're going to get more of it in the next year. So they got 20,000 of that money. Is all 20,000 profit? No. The 100,000 was the total revenue coming in, but there's cost of goods of 75. So really only 25% of that money is profit, right? So on the 20,000 they received in 2013, 25% of that money is going to be profit on that 20,000. And then 25% of that $30,000 that they got in 2014 is going to be profit. Then they started a new installment in 2014 for $150,000, but the cost of goods were $105,000. So we've got to figure out what the gross margin percent rate is, the profit. And so we figure if you take the difference, the 150 minus 105 gives you 45,000. 45,000 divided by 150 is what? 30%. So they got, out of that 150, they got 40 of it in 2014. How much of that 40,000 is going to be recognized as profit? How much? 30% or $12,000, right? Do you guys understand that? How many understand it? How many would like me to explain it again? Okay, let's just keep going on here. So, based on this perpetual inventory method, what they're showing, installment, let me figure out what we did here. So in here, we're looking at cash receipts from other sales. We're looking at, but this installment portion, we're going to understand. So here in accounts receivable and sales, we've got accounts receivable of $500,000, sales of $500,000. We've got our cost of goods sold of $390, our inventory of $390. Then Panther records the total sales and cost of goods sold for the year in normal manner. It doesn't separate the sales recognized under the installment agreement. So cash of $320, accounts receivable get credited for $320. Then Panther recognizes cash collections in the normal manner, 20s for the installment sale, and 300,000 for other sales. So it's going to show the sales, the cost of goods sold, but look what it does here, guys. It's showing a deferred profit of $25,000. Do you see how then it debits your sales, it credits our cost of goods sold, and it credits our deferred profit? Panther identifies the sales recognized under the installment method and the related cost of goods sold, and then reverses them. So it initially puts it in with all of the sales, then it reverses them, and it recognizes the deferred gross profit on the cash collected. So the 25,000 divided by the 100,000 gives us a 25% gross profit rate. So 25% of that 20,000 or $5,000 is going to be gross profit realized. So look what it does. It then reverses that deferred gross profit, and then it credits it as a sales or gross profit realized on an installment sale. Next, as you see here, we've got sales of 400,000 ultimately. Then it shows the cost of goods. So we've got a gross profit of 85. Then we add to that the $5,000 gross profit we have on the installment sale. Okay? So it initially shows it just normally, and then at the end of the period it backs it out. In 2014, the same thing's going to happen. It shows all the sales, all the receivables, all the cost of goods sold, credits the inventory, shows the cash and the receivables. Then what happens, it's going to reverse again that sale recognized under the installment agreement and show the gross profit amount. So we're showing here, that 150 that was under the installment agreement, it reverses the sales, reverses our cost of goods sold, shows our deferred gross profit. Okay, so it's a deferred account. And then once we recognize a portion of that, such as we're doing here in 2014, we then are going to debit that account and treat it as a recognized sale. So a couple extra journal entries. The best way to handle these is to have a cheat sheet. So when you do an installment sale, you know this is normally how I handle it. Then I'm going to reverse it out and show it as a deferred profit. And then in that period I recognize it, I'm going to debit the deferred profit and credit my sale from installment. Okay? Cheat sheets are awesome. Don't you agree? Do you get them in class? Do you get to use cheat sheets when you're taking tests? You should. Because in real life, you don't have to memorize everything, do you? It's true.
It is true.
I say it's
So many
true.
resources.
I said it. Get it? Okay, we'll move on. So, here's an example. Panther repossesses an item it sold in 2013 with a gross profit of 25%, and that the fair value of the repossessed item is $600. If $1,000 of it remains unpaid, guys, we're not even doing that kind of problem. We got enough to deal with. Let's go and look at the 17.9. I told you we're going to keep it simple, right? I want you to understand installment sales, but guess what your problem's going to be on? Percent of completion. Okay? It's the only problem you're going to have. I want to go over this installment sale so it makes sense to you. So if we had a multiple choice, you could figure it out. Okay? But your problem is going to be on what? But do you need to know the definitions of the various types? Yes. Good. Okay, so let's look at 17.9, guys. Are you following me? Sales under the installment method. Okay? Anna Bonita. Wow. Anna Bonita Company began operations in 2013. It sells goods on installment sales contracts. These transactions are considered to be exceptional, so it uses the installment method to recognize gross profit. The following is a summary of the installment sales, cost of installment sales, operating expenses, and collections for 2013 and 2014. Using the installment method to recognize gross profits prepare a 2013 and 2014 condensed income statements for Anna Bonita. We're going to do this? Okay? So, let's clean this up. Okay, so here we're going to have gross profit. We're going to have operating expenses and net income. Okay? So, what is our gross profit going to be for 2013? What are we calling this? A-N-I-B-O-N-I-T-A company condensed income statement. How do I merge it? Where the hell's merge? Oh, merge cells. Okay. So how are we going to figure out our gross profit for 2013? Let's go back. Let's look at the book. The installment sales. Subtract out the cost of the method. Yep. Correct. So we're going to take here 80,000 minus 52,000 is equal to what? 28,000? Right? 28,000? And this 28,000 divided by 80,000 is equal to what, guys? Equal to 35%. Okay? And then it said the collections were how much? The collections were 42,000. How much of that's going to be income? 42,000 times 35% is equal to what? 14,700, right? And what were our operating expenses? 13,000. So our net income here minus 1,700. How are we going to figure our gross profit in 2014? If we have our installment sale of from 2013 of 21,000, 21,000 times what percent? Times 35% is equal to what? 7350? Now let's look at our installment sale for 2014. How are we going to determine that? What is the sales? 90 minus the cost? 59,400 equals what? 39,600? 31,600? Divide that by 90 is equal to what? 34%. And what are we going to take with that 34%? What collections happened? this is going to be 2013's installment. So for 2014, 41,000 times 34%.
Should only be at 30,000.
I'm sorry, what?
It should be at 30,600 over 90.
30,600 over 90 is equal to what? Okay. So 41,000 times 34% is equal to what? 13,940. 13,940 plus 7350 is what? And what are our operating expenses? So our profit, 6290. Make sense, guys? Can someone get me a piece of paper so we can sign our names? Sign our names? Don't you like that?
We'll start over here.
Do you have a piece over there?
We'll start at the
Will you? And then just go up and down. Okay. Any questions? What was the next one? Was it 17, 16? 15. $17.15. Okay, $17.15. Second Life Machinery Company reports the following data for its used equipment sales for 2013, 2014, and 2015. Calculate how much gross profit and net income Second Life will recognize in each year, assuming the installment sale method is used. You know what, guys? I'm not going to work. Well, we'll do it. Let's do this one, and then I want to do another percent of completion, okay? So calculate how much gross profit and net income they're going to recognize in each period. So let's look at this. We're going to go and 17.15 Second Life Machinery. So how are we going to calculate this? Gross profit in 2013, 2014, and 2015. Okay? So we've got here, in 2013, we've got cash collections. We've got sales of 300, cost of goods sold 180. What is the gross profit there? 300 minus 180 is what? 120. 120 divided by 300,000 is what? $120 divided by 300,000 is how much? What? 120,000 divided by 300,000 is what? 40%. So in 2013, that 100,000 of cash received, the 100,000 at 40% is going to be how much we're showing as income? 40,000. Okay. Then in 2014, how much of the 2013 sale came in? How much cash? 100,000. So how much of that is going to be gross profit? %40 still. So aren't we going to show that 40% here, or 40,000? But then in 2014 there was an installment sale, wasn't there? So that installment sale was 330,000 minus the cost of goods sold of 191,400. What was the gross profit on that? I'm sorry, 90 330 minus 191,400. So if we take our 330 minus 191,400, the difference, $300. What did I do wrong here? 330 minus 191,400. 330 minus 191,400, right?
Yeah.
So the difference, oh, I see what I did. That minus this 138,600. The 138,600 divided by our 330,000, what is the profit margin? 42%, right? So how many dollars of sales came in on the 2014 installment agreement? 110,000 at 42% is how much profit? $46,200. Now, what do we do in 2015? Did we receive money from our 2013 installment sale? How much was that? 2013? So we've got 100,000, but at 40% shows profit of 40,000. How much happened for the next year? How much did we receive in?
110.
So we're going to do that one again, or 46.2. Did we have an installment sale in 2015? So we have here an installment sale, sales of 360, cost of goods 212.4. The 360 minus the 212.4, if we take 360 here, 212.4, is that a 41% margin? So how much did we receive in cash in 2015 on that sale? $120 at 41% gives us how much? $49.2. Then we have our total from all. Less our operating expenses. Now we have our net income. So the first year we have a $10,000 loss, net income or net loss. 2014, 26.2, and 2015, 65.4. Make sense? How are we doing, guys? Are we bored? It's hard to go this long at night, isn't it? Is it going to be worse next week when we eat?
No, that's gonna get us so energized.
Oh, it's going to energize you? Good. Okay. We're going to have fun. Okay. Now, guys, it's your job to come up with, like, how many of you guys ever watch fun videos? My husband, I laugh so hard on Sunday mornings as I'm sipping on my mimosas, I'm wetting my pants. Some of them are so hilarious, and it's so, like, stupid. Like a guy farting in the grocery store. He'll just go in the grocery store and just start. Anyway, you have to be, it's hilarious. Okay, we're going to have fun. I'm bringing them. Okay. So, guys, that is 1715. Did you have problem 17.1?
Yep.
What I want you to do, we're not really going to spend time on this, but in your Moodle, you have the solutions. Guess where your solutions are? They're in Moodle. Where in Moodle? I'm going to show you. Moodle. Solutions to exercises and problems. You need to go in here and I want you to look at problem 17.1. How many of you guys have looked at any of these solutions? Do you get that they're there to help you, like the questions? If I know you're not looking at them, I'll remove them. Yeah, I know. I'm joking. So problem 17.1. Look at some of these questions. So that way, each of the following independent situations relates to the recognition of revenue. Interest on loans made by a bank. As the interest is earned, you record the loan. When is interest on loans made by a bank? When the loans are in default, as the cash is received. Just look at these various collection of fares by an airline when the passengers make the reservation. They record the earnings at the time of the flight by the passenger. How many times do they get canceled, guys? Right? Or get bumped? D, when are earnings happen when shipment of freight and mail by an airline before it receives payment? At the time of the shipment. So look at these so it makes sense to you when you record revenues. Okay? Did we have problem 17.3?
No.
Which problem was the next one?
17.6.
We're going to do 17.6 only the percentage of completion method. We're not going to do the completed contract method. What else did you have besides 17.6?
17.8.
Don't worry about it.
That's it.
Let's do 17.6, but we're only doing the percentage completion method. We're not doing the completed contract method. Okay? Got it, guys? Are we good? Do you guys need a break? You just want to get out of here?
You said it, not us.
I know. I'm feeling it. Okay, let's look at 17.6. What page is that sucker on?
17.48.
There we are. 17.6. Oh. Long-term construction contracts. Rice Company signed a contract to build a dam over a period of 3 years for a price of $10 million. Information related to the performance of the contract is summarized as follows. construction cost incurred during the year, blah, blah. Estimated cost to complete, blah, blah. Billings during the year and collections during the year. We're going to prepare journal entries for all 3 years only under the percentage of completion method. Okay? So, let's start by looking at how we calculate the percentages here. So we have 213, 214, 215. We're going to have, sorry. Did you guys hear it might be like 50?
What?
I don't believe anything.
I heard like 35.
Look, I thought we were having a heat wave today. So bad. Okay, guys, sorry. I caused my own problems, don't I? Okay, so in 2013, construction costs incurred to date were how much? 2 million. Estimated cost to complete? Estimated cost to complete. Yep, 6 million. You're right, man. 6 million. Total estimated costs here. Total estimated cost here, 8 million. Here, whoops. So, percent completed. Okay, so guys, basically what we're doing is we're setting up the construction cost incurred to date with the estimated cost to complete to come up with a percent completed of cost. So the percent completed here, darn it, what the heck am I doing wrong? There, divided by this. So for here, we've got percent completed of 25%. Here we've got Here we've got percent completed of 50%, and then we have percent completed of 100%. Okay? So in the revenue to date, so how much revenue to date do we have in 2013? 2,500,000. How did we calculate that? Whoops, 2,500,000. Okay, the revenue to date is 2,500,000. How much revenue did we recognize? In the first period? Billings during the year. collections received during the year. So the billings, or the amount recognized, is we recognize the amount that based on the cost. So in this year we recognize $2,500,000. How many dollars of costs were incurred? How many dollars of costs were incurred? $2 million. We're going to get that figure from here, right? So our gross profit recognized is $500,000. Okay? Now revenue to date in 2014, our revenue accumulated to date is maybe a better word to say, accumulated, you know, to date. Whoops. Is 10 million plus what percent? 50%? Or $5 million? How much revenue was recognized in this period? 2,500,000. How many dollars of cost were incurred during this period? So here, this is kind of tricky here. Technically, we would be taking this 6 million and putting it down here, right? Right? And what would that show? A loss of 1,900,000. Since
Also, wouldn't it be 4 million? Yeah, because it's only for the 14.
okay, one sec, guys. So what I'm trying to show you is ultimately we know we've got a profit here, okay? Or we should have a profit. But what is the cost at 10 million? Ultimately, what did we think our, what was the total amount of the contract? 10 million, okay? But what are they ultimately expecting the cost to be? This is a problem, isn't it? So because all of a sudden now the costs are being expected at 12 million, are we going to have a profit here? We're not going to have a profit at all. What's going to happen here? We're going to have a loss, aren't we? And what kind of loss are we thinking we're going to have here, guys? A $2 million loss. Look what we did the first period, though. What did we show our profit to be? Right? The minute we know now we're going to have a loss of 2 million, okay? We recognize it. We know now there's a loss here of 2 million. We're not going to show any revenue. I mean, if we've got to show this revenue recognized of 2,500,000, what are we going to show our cost incurred to be? We're going to force it at 5 million, Why are we going to force it at $5 million? Because ultimately, we know it's a $2 million loss. But since we already showed profit of $500,000, that was bull, wasn't it? So instead of showing a $2 million loss here, we're going to show a $2.5 million loss to compensate for the first year. Make sense? Yes.
So for the cost incurred, I thought the cost incurred was supposed to be $4 million because for 2014, that's the cost for that year. So we use the total of the last 2 years instead of just.
Okay, you're right. But you're right. We should have used $4 million because here it was 2, and then here it's 6, which means 4 here. But we know there's not a profit. Why do we know there's not a profit? What is the contract for? And what are we now determined that our costs are going to be? We initially thought they were going to only be $8 million. That would have been a nice profit, wouldn't it, of 20%? But now that we revised the numbers, what's happening to us? There's no more profit. So in the period we realize we've got a loss, we're going to recognize the loss. Okay? It's now we're going to recognize it. Make sense? Kind of tricky, isn't it? The main problem that we're going to have, I'm going to show you. Let me find it so I can show you. You want to go through a problem we'd have on the test? Okay, let me put this. Okay, let me get my. Okay, you're going to have a problem just like this. Well, I thought I... Don't be looking at my bad emails. It's terrible. It's not as bad as it looks. That's pretty bad, isn't it? Oh, just stop it. That's not really... How many of you guys have gotten responses from me? I've been pretty good. I have so much junk that comes to me every day. Okay. Good. There it is. Okay. I know it's sick that I have to email myself to put stuff up. Okay. Y'all ready? So here's the problem. Are we good? We're going to do it now? Okay. So, we've got here, Thompson Company Construction began a construction project in 2014. The contract price was $1,250,000 and the estimated costs were $1 million. Data for each year showed cost incurred for the year 2014, 2015, 2014, 2015, and 2016. So we expect it to be $1,250,000, and cost incurred during the year $250,000, $600,000, and $190,000, right? Estimated cost to complete what is it? Expended in year. And then estimated costs to complete are $750,000, $212,500, and $0. Okay? Then we have partial billings of $375,000, $500, and $375,000. And we have collections of $187,500, $469,000, $593,500. Okay? Are we good there? So we're required, assuming Thompson uses the percentage of completion method, determine the balance of construction in progress at the end of 2014. So how are we going to go about determining this? How much revenue are we going to show? $2,014. What are our total costs expected to be here? Huh? $1 million? And so what are we going to do here? Our $1 million is what we're expecting. And what is the cost expended is how much? 250 divided by this 1 million, or 25%? Shoot. Right? So how much are we going to show in revenues? How much are we going to show in revenues? 312, 500. How did you figure that? 1,250,000 times the 25% gives us our 312,500. What are our costs? Construction expense, 250. What is our gross profit? Is what? $62.5? Right? Isn't that our gross profit here, $62.5? What should be our construction in progress? Would it be the $250 we've expended in costs plus our $62.5 or $312,500? Okay? Next, I'm recording this so you guys can listen to this again. Next, prepare the relevant sections of the income statement and the ending balance sheet for each year under the percent of completion method. Okay? So, let's look at the current assets. Let's look at this. Okay? We've got current assets. We've got inventories. What's going to be our construction in progress? What year do we need to do this for?
For each year it says.
Whoops. Sorry, I'm messing this up. The balance of construction at the end of 2014. Okay, how the net income for construction in progress inventory should be reported on the 2015 balance sheet. So how should we be reporting the net amount for construction in progress on the 2015 balance sheet? You know what? Don't worry about that. How would you report it on the 2014 balance sheet? 312, right? Let's just do how you would report it on the 2015, but I'm not going to test you on this because that gets too tricky. But how would you report it? What do you think, guys? Anyone want to take a stab at it?
You mean like the journal entry for it, or?
No, how much money? So what we would do, the revenues to date would be, revenue to date would be the $250,000 plus the $600,000, and then you would divide that by the $250,000 plus the $600,000 plus the $212,500. I'm not, guys, I don't want to get too confusing. If we're only going to spend a week on this, I don't want to do this, okay? I would want you to know how to do it for the first year, but I don't want to confuse you with it overwhelming here.
For the first year it's $312,000.
Correct. Let's, though, do this last one here. How could we determine the gross profit for 2016, guys? How will we calculate it for 2015?
Do we have to add those?
So, let me just do this. The gross profit for 2016.
So for the cost incurred for 2015, does the 600,000 include the 250,000, or are we adding it together?
Cost expended in the year. So no, we would have to add it because this is only the amount expended in the year. It doesn't say cost expended to year to date or cumulative. It's just in the year. So how would we calculate the gross profit for 2015, guys? Would we take the 250 plus the 600 plus the 212 and have that as your denominator, right? So our total cost should really be these two plus this. Whoops, didn't like that. Plus this, and then wouldn't we take, to come up with this number, this plus this, and then divide it by this, right? Correct? So if we know that in 2015 we would have already claimed 80% of the profit, how much do we have left to do in 2016? 20. So if we take this amount times 20%, sorry, and what would we subtract from that? The 190,000? What would our profit be in that year? Would it be 60,000? Okay, so what I did is I did my 2015 to see how much we've already shown in gross profit. So 100% minus what was already taken is, this is 20% left. So 20% times the 1,250,000 gives me the amount of our revenues recognized. Subtract from that, excuse me, this is where I should have this here, and this amount is the 190, the cost incurred for the period. So the gross profit is going to be the difference, the revenues minus the costs incurred, or we're going to have a gross profit of 60,000 left. Does that make sense? That's as hard as it's going to get for a problem. Do you want to go over more? How are you doing? Great?
Take any more information.
Are you guys burnt?
My brain is done.
Now, I sure don't want to... Yeah, let me shut my... Where's my